Hi, Steve Sosnick here with today's Interactive Brokers midday market update for September 22nd, 2020. It's actually a bit earlier than the usual midday market update. Let's call it a morning market update or a post-open market update. So what we're seeing now is a bit of a bounce. Yesterday we saw the bounce actually start call it mid to late afternoon. The Nasdaq, which had been leading the market lower, found some support, probably because the stay-at-home trade reasserted itself. What we saw in Europe is a worsening of the coronavirus, and I think that the markets originally that was one of the factors that caused us to sell off yesterday. I think U.S. politics was probably the main reason, but that was one of the causes, and I think as people started to think about the ramifications of potentially a worsening virus situation in the U.S., not that one is evident yet, but I think the theory among some investors was if it's getting bad in Europe, it's probably going to get relatively bad here, or not as good. But regardless of that, the stay-at-home stocks kind of led the bounce. We saw which the stay-at-home stocks were what led the market up before. Those tend to be the big tech stocks: Amazon, Apple. We saw Walmart higher. We saw Netflix higher. That could also have been partially because of their success at the Emmys, but still, those were the type of stocks that led us higher. The FANG type of names. I think they kind of shrugged off the TikTok stuff that was behind it, but that could have helped Walmart in some regards. Bottom line is we found a level, we bounced, and we at least trying to continue that first thing this morning, although even as I'm talking, that bounce is fading. I think it was a little too far too fast, and that's what happens when you get into we're not in a bear market. We're barely even in a correction, but bear market bounces tend to be short, sharp, and furious. And again, I think it's premature to say that this was a bear market. We're barely in correction territory, depending on which index you're looking at. But if you're in the midst of a downtrend, they take that characteristic. And even a downtrend is a little tricky. I put out some charts yesterday showing that we're not really quite in the downtrend yet. S&P, the longer-term moving averages have just started to kind of roll a little bit. And when I say longer-term, I'm going to say 30 and 50-day. We haven't even tested the 100-day moving average yet on S&P, which is about 3188, which is where I think actually some real support would be found. And Nasdaq, we're starting to see the 30 and the 50-day go lower. Bottom line is Nasdaq was riding the 30-day moving average higher, and it broke that, and then it broke the 50-day moving average, and now it's trying to find its new level. And the longer-term trends have turned, but not definitively so. So we're kind of at best a turning point in a consolidation level, at worst a turnaround. But it's too early to say which it is yet. As far as S&Ps, we were riding the 50-day moving average, more or less the same way. It was riding the longer-term moving average because it wasn't accelerating as quickly. We broke down through that, and yet again, those indexes, the trend lines have started to turn down. We've seen like the 10s and the 30s cross kind of thing, but not a terrible technical situation. Another thing that people have been starting to focus on, and I'd like to think that I was in the forefront of this wave, is the fact that VIX futures are pricing in some election uncertainty. We noted last week that the November VIX future started to tick above the October VIX future, meaning that people were more concerned about volatility after the election than they were before the election. And that's kind of a worrisome sign. And we did see some of the vols in let's say December, January VIX, the levels in December and January VIX start to kick up. And while there was a bit of a parallel curve shift upwards in the curve, largely because of the overall volatility in the market, those levels lifted a bit more than the front month. And so this is something to keep an eye on. I think people are buckling up for some real uncertainty. As I said on a Bloomberg TV interview yesterday, volatility cuts both ways. We tend to think higher volatility when things go down. Volatility can happen when things go up. And as I just mentioned, some of your sharpest rallies happen during down markets. So volatility in and of itself is agnostic. Volatility tends to be lower. Markets tend to display lower volatility when they just kind of ratchet higher, which is what we saw through most of the spring and summer. Now we're going to start to see a little bit of backing and filling. At least we have. We'll see where that goes over the next few weeks. And happy trading, everybody. Take care. Bye-bye.